In case 31, this time we have another company, not the California Pizza Kitchen anymore. This company have a different amount of debt and equity, and also have different proposed structure. So right here you have a 100% equity but 0% debt, and right here is a quarter and three-quarter combination of debt and equity, and here you got a half-half combination of debt and equity. And the total capital is always $10,000 in the book value. And in the market value, it could be different because the equity, as I said, could be determined by the amount of net income. So this all needs to be calculated later on. So let's first get started with this number, the market value of a debt. Well, as I said, the market value of equity and the market value of debt and the book value of a debt is usually the same. As in the previous case, it was assumed they both are the same, are equals. So I just use the market value of debt equal to the book value of debt, and then drag it all the way to the right. So the number does not quite change. You can put a dollar sign there and decrease decimal to make it consistent. All right, and right here you have a market value of equity, but we are not prepared to do that yet. So let's just move down. So pre-tax cost of debt is 5% is as given, and from here you can calculate the after-tax cost of debt. You need to know what the tax rate is. Right here it is given as 34%. So you are going to use the 5% multiplied by the 1 minus tax rate, which is the 34%. Okay, so that's how you get that 3.3% after tax cost of debt. And then you need to calculate the market value weights of debt and equity. Still, you are not ready for that yet. In order to get the market value of equity, so let me just type it right here, market value of equity, you need to have two things, all right? It is first, the net income of each year, and the second is the cost of equity. You know, cost of equity is also the return of equity, and we have done a CAPM analysis in class, try to figure out what cost of equity is. In particular, we used a CAPM model to calculate cost of equity. So what information do we have in the CAPM to get a cost of equity? So you have a levered beta, you have this risk-free rate, and a market risk premium. And you should know that the market premium, it is basically the market rate, market return. We usually use a Standard & Poor 500 as a market index minus the risk-free rate. All right, so the market premium here is 6%, and you also have a beta of 0.8. So in the CAPM framework, let me just write it up here. So in CAPM, you have the return of an individual stock, okay, a return of individual stock minus the risk-free rate equals to the beta of a market premium, which is the market return minus the risk-free rate. All right, and this is the return of that individual stock. It is also the cost of equity to the firm to raise money from stock investors and to pay the stock investors. So this basically is your cost of equity. All right, and this RI could be RF plus beta times RM minus RF. All right, so this is what we're going to do. We have the beta given here as 0.8, and we have this market premium given as 0.6, and we have this risk-free rate given as 5%. Sorry, this is not 0.6, it's 0.06. It's 6%. All right, so how do we get this cost of equity? Then I'm going to use the risk-free rate plus zero point 0.8, which is the beta, times the market premium. Okay, so that is the cost of equity. Make it a percentage. That's 9.8%. And for the weighted average cost of capital, this is something we have learned before. It's the same old trick. For the WACC, it equals to the cost of debt times 1 minus the tax rate, which you already have. That's a 3.3%, times the weight of debt plus the cost of equity, which you just solved based on the CAPM, times the weight of equity. All right, so now you have a weight of debt, which is 0%, and the weight of equity, that's 100%. And you already have this cost of equity, that's 9.8%. So you can easily figure out what your WACC is. So you're gonna use 0% of debt. Well, I just need to use the right item nonetheless. You already have the after-tax cost of debt plus this 9.0% for cost of equity times 100% weight in equity. So your WACC is just the cost of equity because you have a fully equity financed firm. And then you have the EBIT given. It is 1485. And right here, you can calculate the tax you need to pay. So this is the EBIT times 34% tax rate. It should be 34% tax rate. Okay, and then I can drag it all the way to the right. All right, so now you have a term called a EBIT, that is earning before interest but after taxes. So you are going to use EBIT minus the tax amount. Okay, and then you need to add back depreciation. You need to subtract all the capital expenditure. You also need to incorporate the change in net working capital, which are the important ingredients to calculate free cash flow. So if you combine all of this, just take the sum of all the numbers here. So that's where I start, 980 plus 500, because depreciation was a non-cash term I subtracted before. Now I need to recoup it, and then I subtract the 500 capital expenditure and also 0 for changing net working capital. So this is my free cash flow. So the free cash flow is the same. Okay, the free cash flow is the same. And then to get the value of the assets, I will need to use the free cash flow divided by the my WACC. Okay, divided by my WACC. So it is roughly $10,000. It is having $1 off. I think that's okay. This arrow is okay. It's just mostly due to the rounding issue. So back to my market value of the equity, I can use whatever I just calculated right here. Okay, so make it link. So what really matters here is if you look at a company's value, so the value is the present value of all the free cash flows in all the different years. So let's say you have year 1, year 2, year 3, and I'm going to simulate so many years, and each year the company is making $980 free cash flow, and this free cash flow incorporates the capital expenditure, incorporate the um, earning before interest and after taxes, incorporate change of net working capital, and also recoup the depreciation. Okay, so that's the total free cash flow for the entire firm. And then the company is making 980. Assume we forecast the company is making 980 all the way for the next 50 years. Well, definitely it's going to be different than 980, but we don't have any more information to do the forecast. So 980 is our best guess for the free cash flow in year 2, year 3, year 4, and year 5. And then if we get the discounted value, okay, or the present value of the free cash flow, I'm going to use the discount rate, which is my WACC. You know, WACC is my cost of capital, of which I shall use as the discount rate for the cash flows. So my cash flow divided by 1 plus this 9.8, the WACC, I need to log it, all right, and then raised to the power of 1, just discount it for 1 year. And then I will keep discounted for 2 years, 3 years, 9 years, and then all the way to whatever the year number is. Okay, so for all the free cash flows at the present value, they are a different amount. And of course, if I just extend my simulated years, then I will have a number more, not $80 made, and then but the value added to the total is diminishing. You see the present value of the same 980 is becoming less and less when the year extends. So if I add all the numbers here, so it's roughly $10,000. Well, it's not exactly 10,000 because I didn't extend it to infinity. So what we should do actually is to assume infinity. That means the infinite amount of years. So if I do that, then the total will be ultimately close to 10,000, or just the 980 divided by 9.8%. So you have 2 ways to get this $10,000. One is to simulate infinite amount of years with infinite amount of free cash flows with infinite amount of present values of all the cash flows, and then add them up. And the second way, thanks to the mathematicians, we can just use the free cash flow in each year divided by the discount rate. All right, this is something we learned in the principal finance class. In particular, is called perpetuity problems. Okay, so now things are getting more complicated since you have the debt getting involved. Once you get debt getting involved, so something gonna change. First is your beta is changed to a levered. Okay, so you have a levered beta. Okay, and the levered beta would be different in terms of estimating the cost of, would make a difference in terms of estimating the cost of equity. So in the capital structure chapter, let me just erase this. You have the beta, which is purely determined by industry. Okay, or there's no debt being considered here. And then you have a beta for debt times the weight of debt, which is the dollar amount of debt divided by the debt and equity combined. So this is a percentage telling you the how much debt in the total capital. And then you have equity here divided by the total capital multiplied by the beta for the equity only. Well, the thing is, the beta of debt is extremely insensitive. In other words, if you're looking at the debt market, the return of a debt is so insensitive to the return of the entire debt market, and then your beta should be zero. Okay, so you can assume the beta of debt is zero. So with that being zero, so this whole thing could be eliminated just because the debt is so insensitive to the market. So this beta for that debt is so limited. Okay, so right here you can rewrite the equation. You put the levered beta for the equity, and that is the beta as if there's no equity or there's no debt in the capital structure. It is purely determined by the industry, determined by the firm, and then it is the total capital divided by E. So what you see on the board here is how to solve the levered beta based on the unlevered beta and the company's debt and equity structure. And we have a very big assumption right here that there's no tax getting involved. If we do consider tax, things are getting a little bit more complicated. It is not mentioned in your PowerPoint slides, but if I ever ask you a question on that, it could be extra credit. So what is the levered beta when we do consider tax rate? So let's see, right here we have the beta for debt, okay, the beta for debt, and the weight is the amount of debt divided by the value of a levered firm. If it is no tax being considered, this VL, value of levered firm, should just be debt plus equity. But here I rather keep it as value of levered firm. And then we use the beta of equity only, and the weight here is the value of equity divided by the value of a levered firm. And then you have the firm value, which is which is the value of the levered firm minus the tax times the debt. Okay, and you have value of a levered firm, and this is your beta for unlevered firm, okay, or your beta 0 as I wrote on the board over there. So this part, well, I didn't enjoy it very good. So this part right here, it is the value of unlevered firm. Remember, the value of unlevered firm plus the value of debt times the tax rate is the value of a levered firm, as I have mentioned that in class before. And that's not end of it. It should be equal to the debt times the tax rate over the value of a levered firm times the beta for debt. Okay, so that's a lot of things we need to write. As I said, this is just for extra credit. If you want to skip this part, that's completely fine. So this value of the beta of a debt right here, they're all equal to 0. So basically you can delete these terms, and then you only have this term and this term left. Oops, this needs to be bigger. Okay, so if we want to solve the equation and put the beta for equity on one hand side, and you should know that this denominator, okay, will be canceled out as well. So if I rewrite the whole equation, it is the value of equity multiplied by the value of the beta for equity. It equals to this value of a levered firm. You can use a D plus E, okay, minus TD, okay, the whole thing multiplied by the beta for unlevered firm, or the beta 0. I put it on board just to be consistent. And then if I scroll down a little bit, okay, if I scroll down a little bit, so this beta E equals to, okay, D plus E minus TD divided by E times beta 0. So if I want to rewrite it, okay, it is basically the 1 minus T times D, okay, over E plus 1, okay, the whole thing multiplied by the levered beta. So we do need this to calculate our levered beta in case 31 of your textbook in that Excel practice. So you need to remember the levered beta for equity equals to 1 minus the tax rate times the debt over equity ratio plus 1, then multiplied by the unlevered beta. So now let me go back to Excel. So this is where I got left out last time. So right here you have need to solve the levered beta. So it equals to the levered beta multiplied by 1 plus then 1 minus the tax rate, which is the 34%, okay, times the amount of debt over the market value of equity. So since all the betas are measured in market terms, these are determined by the debt and stock markets, the trading behaviors in those markets. So we have to use the market values of a debt and equity instead of a book values. So just keep that in mind. Since I will drag it all the way to the right, and I will keep using this unlevered beta when you have a 0% debt. So I will lock this B18 for 0.8, the unlevered. So I just need to complete that parenthesis, and then I drag it all the way to the right. So this is how I write the formula for the levered beta. So right here you get a 0.69, right here you get a 1.19. And then if I need to calculate the cost of equity, I just simply need to drag it all the way to the right. So this would give me a 10.7%. This would give me a 12.2% for cost of equity based on the levered beta and the same risk-free rate and the same market premium. And for the debt equity ratio, so I still will keep using these numbers. For the percentage of debt, I will use the debt amount divided by the summation of debt and equity in the same column. Since I'm going to drag it to the right, and when I drag it right, I want the column to be shifted. So I don't want to lock the column C here, but I do want to lock column row 8 and row 9 because I will drag it down. All right, so I drag it down, then you will see I have a different numerator, but my denominator will be still the summation of the same two numbers. But if I drag the two numbers to the right, you will see that I use numbers in different columns. All numbers are in column D. Again, for the denominator, it is locked, and when I drag it down, as you can see, the numerator shift from D8, D9, but I use the same numbers for the denominators. Okay, you can also verify from the summation of the two numbers, they always add up to 100%. Now I got the weights for debt and equity. I got the cost of equity and the cost of debt after tax. So all I need to do is to calculate the WACC, and all I need to do is just simply drag it to the right. All right. So right here you have the WACC under different debt structure. To calculate the value of assets, you just need to use the same free cash flow divided by your WACC. Okay, and then I drag it to the right. So these are my numbers. I decrease the decimal. I'll make it look a little bit short and crisp. So now I need to get back to where I got the number from. So this is the market value of equity. As you can see, the total of debt and equity would add up to this total assets. So in other words, I can basically use a formula to get the market value of equity, which is the total assets minus total debt. Okay, where I got the total debt, I got it from the book value up there. So it is the formula already. So where I got the market value for equity, I'm going to use the newly solved total assets minus the market value of debt. Okay, and then I drag it to the right. As you can see, there's only $1 off because the textbook has some rounding issues, and my number is more exact. So if you had a problem of iteration, be sure to check options, okay, and check formulas, and make sure this part is enabled. If you disable that, you will have a self-iteration problem. So where that comes from, basically you use a market value of equity to get your weights for debt and equity, and you use this number to get your levered beta, and then you use the levered beta and all the ways to get your WACC to get the value of assets. So basically the value of assets is from the market value of equity somehow, and also the market value of equity is from the value of assets, as I used the difference between assets and debt to solve for that. So this is called a self-reference problem. In order to solve that, as I said, you're gonna enable iteration in your options formulas as we have done it before in the pro forma analysis. In problem set 1, we try to learn how to calculate the firm's total assets based on the free cash flow analysis and the weighted average cost of capital. In problem 2, we still are working on the company's total value. This time we're going to solve for the value of equity, and then solve for the value of a debt, and then use the summation of the two to get the total value of the assets. Okay, so this is something I wrote earlier. So let me just briefly introduce what we are going to do right here. So in problem set 1, we learned that the value of a levered firm equals to the free cash flow divided by the weighted average cost of capital. Okay, and the weighted average cost of capital right here is made of several components. So you have a weight of a debt, weight of equity, and in particular you have this cost of equity, okay, RE, and this comes from the CAPM analysis with beta E times the RM minus RF. So this is the levered beta we use to calculate. Okay, this is the levered beta we need to calculate. And in problem set 1, that's what we did. And in problem set 2, we are still trying to solve for the value of a levered firm, but this time we're going to make it equal to the value of a debt plus value of equity. All right, and also you can solve it by using the value of an unlevered firm plus t times the level of a debt. Okay, so how do we get the value of a debt? Well, still we're going to use the perpetuity analysis. So if the value of a levered company is depending on the free cash flow generated by the company divided by the weighted average cost of capital, then for value of a debt, it should be depending on the interest expense in dollar figure divided by the interest rate. Okay, and for equity, it should be the net income, which belongs to the equity holders, okay, divided by the cost of equity. All right, so this is what we do in this Excel practice. So right here, you will see that you have interest expenses. Basically, it's generated from your level of a debt. So we can use the number in the previous problem. So that's a zero amount. So you get a 0. You see this is from a B5, and the B5 multiplied by the 5% pre-tax debt cost, and then I just drag it all the way to the right. So you will see the same number being produced here. I just plug in the numbers. So for example, this interest expense, which happens to be 250, it equals to the 5% which I used here multiplied by the 5,000 in the spreadsheet problem 1. Okay, and to get the value of the debt, and that's pretty simple. You just use the interest in dollar figure divided by the pre-tax cost of debt. So 0 divided by that, you get 0, and then if you use 125 divided by 5%, you get 25,000, and right here you get 5,000. The whole idea here is that take this for example. If I use if I keep paying interest every year, okay, and each year I pay $125, so that's year 1, year 2, and I'm going to simulate so many years, a bazillion amount of years. Okay, let's say I have 600 of them, and then each year I pay $125, and the present value of the interest will depending on the actual dollar figure divided by the discount rate, and the fair discount rate would be the 5%, right, raised to the power of 1 for year 1. Okay, this is the year number, and then I will discount for another year, okay, then for another year, so on and so forth. Just decrease the decimal. As you can see, when I extend all the years, basically the $125 interest payment will shrink to a present value of 0, and all I need to do here is to add all of them, all the present value of interest all together, and if I add all the zeros as I shown you, then it doesn't change my number, so I would get a total value of the debt based on the cash flow it generated as $2,500. Okay, so once again, this is a perpetuity problem. We assume infinite amount of years, and we assume we keep receiving the interest $125 for all these years. Then the present value of all the cash flows would add up to this number. Okay, so let me recoup the setting, the colors. And here, to get the EBIT, well, the company is making the same EBIT as it was listed here. So I just use the EBIT minus the interest. So the interest is linked to the top right here. Okay, drag it. And then the pre-tax profit is EBIT minus interest, and then drag it, and then the taxes is 30%, 34% of that, and then drag it. Then your net income would be this taxable income minus your taxes. Okay, and then for the residual cash flow, it equals to the net income plus all of this depreciation minus capital expenditure and a change in net working capital. Just use the summation for all of this. Okay, and for cost of equity, this is something that I have solved earlier, so I just directly borrow from the first spreadsheet. Okay, so that's 9.8% for the first one, and 10.7% for the second, 12.2% for the third. And the value of equity, so basically I will use the residual cash flow, just anything but interest payment. Okay, so that's the value of equity I got here. And then right here I use the residual cash flow, which incorporate this depreciation, interest, and so on. And then for the next structure, and then for the value of equity plus the value of a debt, so right here I will use the value of equity plus whatever debt I had above is 0, so it doesn't change at the end. And then if I keep adding, so you will see the value of equity plus the value of debt actually changes. Okay, so from this way I can get the same value of a total assets, okay, which is the value of a debt, okay, plus value of equity, and they both use the perpetuity model to do the work. And I have to put some improvement here for the net income. I actually have to incorporate depreciation. Looks like an O, sorry. Oops. For the net income, I have to incorporate the depreciation, the capital expenditure, and also change in net working capital, and all this. All right, so that's basically what I did. First, I solved for the value of a debt, which is basically a given number, and then I solved for value of equity, and then when they add up, the value happens to be exactly the same as I solved in problem set 1. That is the free cash flow divided by WACC. Okay, they match each other. And in terms of how do I get to this TD, tax rate times the debt level, so that's pretty simple. So I can use the value of the unlevered firm plus the tax shield of a debt. So right here I have the value of the unlevered firm plus the tax shield of debt, since I have a 0 debt here. Okay, multiply by 34%, that's going to give me 0. And then I will keep using this value of unlevered firm. When I say unlevered, that means this firm has no debt at all. lock that number, and then drag it all the way to the right, and you will see the number still matches. Okay, so the value of unlevered firm plus the amount of debt times 34%. So that's a tax shield provided by the amount of tax of 2,500. And then I drag it, and you will see the number do match. So there are several ways to get this firm value. One is use a free cash flow divided by the WACC. Another is the value of debt plus value of equity. The third is the value of an unlevered firm plus tax rate multiplied by whatever the debt is. Well, I hope this is incentive enough for you. So now you are done with the two exercises, okay? And you don't need to worry about problem set 3. You don't need to worry about problem set 4 or problem set 7, okay? Just relax. I think what I have taught you. So all you need to do is to turn in problem set 1 and problem set 2. So these are all the numbers you need. And if I ever test you on the levered beta like this, when tax rate getting involved, so it would be extra credit. But for all the rest, those are required knowledge. The knowledge appeared in this PowerPoint slides, which will be covered or have already been covered in class.